Saurabh Mukherjea from Marcellus Capital on the show with us then. Saurabh, hi, good morning. Just wondering where this volatility is going to lead and how to make sense of the madness in the markets right now. What is your own sense? I mean, sure enough, we've had a great ride and a great post-budget rally. But since then, the juggernaut has really gotten derailed in that sense. And it's the heightened volatility which is a little, unnerving.
Morning, Aisha. So, Aisha, if we cut through the noise, the underlying economic picture is actually quite clear. Not just in India. Actually, globally, the picture is quite clear, and you can see this in the sense shortages are getting showing up. Shortages of semiconductors, of shipping containers. You can see this in the electricity demand numbers we are seeing in our country. You can see this in the car demand, housing loan offtake we are seeing. Now, the picture globally is of a reasonably robust recovery in the wake of COVID. Obviously, we're going to go through these waves of COVID, whether it's in Europe or in India. We'll go through these waves of COVID. We've seen this now for 13, 14 months. But leaving that aside, the economic recovery pattern is pretty steady, pretty robust. And I think that's the main picture we are focusing on. Day-to-day market volatility, I don't think has got any great value for us to focus on. We focus on the fact that large, well-run companies in our country are growing earnings at around 25 to 35%. That was true for the December quarter. And my reckoning is March quarter numbers will also show 25 to 35% earnings growth from large, well-run companies across various sectors in our country. And that's a pretty good place to be in the early stages of economic recovery.
Sure. I get your point that, long term we're intact. But for the market right now, given this is something we track on daily and an hourly basis, Saurabh, would you be then tempted to buy this decline in the market right now? Because if your conviction is so strong on the what India Inc. is going to deliver in terms of earnings, from that peak of 15,400 plus levels, and not just the index, but in individual stocks as well, we've come off about 10 to 15% across the board from the top. Are these good levels then to start nibbling in once again and maybe adding to the positions in the names that you already hold in your portfolio?
So, Aisha, over the last 12 months or so, I was doing the maths yesterday evening. Over the last 12 months or so, in fact, 12th or 13th March last year when the market went gap down, I was on one of your shows. And I remember running out to speak to my colleagues about how much we wanted to buy when the market went gap down. So over the last 12 months, pretty much every day, we have put around 20 crores to work. Incrementally every day, we put 20 crores to work. So in the course of a year, in the course of the 12 months since the lockdown began, we have put 4,500 crores to work in the Indian market. And we are continuing to do that. We honestly don't lose sleep about whether the market's fallen 1%, couple of percent, 5%. Every day, we put around 4-5 crores to work over the course of a typical working day. Over the course of a typical working day, we put around 20 crores to work. And we'll carry on following the policy, both in terms of domestic investors who are Marcellus clients and increasingly foreign investors who are coming to us, asking us to deploy their monies in the Indian market. Our view is that the next 2-3 years will bring further flows into India. As we get further money from investors, we'll keep deploying monies. We are not going to lose too much sleep about day-to-day market volatility.
Sure. Soon, Saurabh, we're going to be tracking IT earnings. What is it that you believe IT as a pack can do going forward, what's already not priced in? I mean, we all know that Indian IT, so to speak, is the cloud kitchen for IT services for the rest of the world. We all know the earnings visibility and the growth potential within IT, but that is something which is well discovered. Even the managements have come out and, given that indication and guidance on where they believe the growth potential to be headed. Where is it that you think the dark horses could be wherein the market still hasn't discovered the full potential?
I'm not so sure Indian IT is fully discovered in the sense there's this bizarre notion in many parts of the Indian market which sees IT as some sort of defensive sector. Never quite understood how in the age of technology that we live in, how Indian IT services can be a defensive sector. And I think the Indian market is still getting accustomed to the notion that in a world where, as you nicely put it, Indian IT is the world's cloud kitchen. It's a beautiful, I think, metaphor you've used. I think the market is getting accustomed to the notion. So Accenture's blazing results last week, I think, will be a good precursor to the Indian IT heavyweights posting further jumps in their order book. We've been long-standing shareholders of TCS in several of our portfolios. Over the last 3-4 months, we've also started building a position in L&T Technology Services because we are seeing a significant recovery across the world in capital goods and machinery. And L&T Technology Services is a rare Indian IT company, which is specifically a play on technology going into capital goods and machinery. So I think there is significant upside in IT over the next 2 to 3 years. Scale gorillas like TCS have been long a part of our portfolio. The recent addition is L&T Technology Services.
Saurabh, have to ask you, any hidden gems, anything that you've identified from the, from the mid and small cap space, which in this correction you've been tempted to buy?
So I think for a good part of 2 years now, we've been talking about how Indian specialty chemicals is coming of age. My reckoning is Indian specialty chemicals today is where, say, the Indian pharma sector stood in the mid-90s, on the cusp of a golden 20-year run, or say Indian IT services stood in the early 90s, right? And Indian specialty chemicals, both in terms of supplying the domestic market, which is burgeoning, plus in terms of becoming large exporters. I think there's real potential here. We have good process chemistry talent in our country. One would argue we actually have world-class process chemistry skills in our country. And there is an environmental arbitrage. China and the West don't want to make this stuff anymore. And increasingly, this will come to India. So a company that we've researched diligently over the last couple of years and then built a significant position over the last 12 months is called Fine Organics. So anybody who's watching this show and has had bread or biscuits this morning, it's highly likely your bread or your biscuits have contained Fine Organics as emulsifiers and they're antifungal agents. They're a market leader in this. Majority of India's emulsifiers and baked products and antifungal agent in baked products comes from Fine Organics. Market cap is around $1 billion. Return on capital employed 35%. High barriers to entry, very difficult for others to come in and displace Fine Organics, given that their clientele is a marquee clientele of leading Indian FMCG and in some cases leading global companies. So high barriers to entry, consistent reinvestment back in the business. I think 20-25% earnings compounding over a long time to come should be feasible for Fine Organics, and therefore we've built a substantial position in this small caps specialty chemicals company.
Saurabh, when it comes to auto companies, on the one hand, they are facing that conundrum of the higher input costs, raising prices. On the other, really reworking their strategy. For instance, Ralph Speth now with TVS Motor, looking at a very strong global presence over the coming years. How are you seeing the story unfold when it comes to autos? Is it going to be survival of the fittest, or do you reckon that as things gradually open up and as we see a sense of normalcy, really things are going to be pretty much back to normal and on a steady footing?
Let's break it into two parts. One is the current sort of the 1 or 2 year outlook, which, as you nicely put it, is about dealing with input cost inflation, whether it's steel inflation or it's the whole shortages of semiconductors and containers. And we can see that the market leading companies such as Maruti are pushing through multiple price hikes. I think Maruti is about to take its second price hike, and Maruti sits in several of our portfolios. So the 1 or 2 year outlook is largely about, are you a category leader and therefore have pricing power to push through price hikes, or are you a number 2, number 3 player and hence you'll suffer margin pressure? So I'll be very wary, both in auto OEMs and in auto Ank. I'll be very wary of buying the number 2, number 3 players. Buy the leader who can push through price hikes, because as night follows day, cost inflation will only get worse as the year progresses, because as the economic recovery takes further hold, I think we will see further cost inflation coming through for the auto and the auto Ank. So we're playing market leading auto Anks, say, such as Lumax in the headlight space and Maruti and Royal Enfield, Eicher Motors in the OEM space. Now, the more trickier call is 3, 4, 5 years out, how meaningful does EV become, right? I'm no expert on this. We are trying to get our heads around it. It does look like that particularly in cars, over the next 3, 4, 5 years, we will start seeing low-cost electric vehicles come to India. And therefore, we're trying to figure out to what extent are companies like, say, Maruti exposed to that. Royal Enfield and Eicher Motors, I think, has less exposure to that because a bike like a Bullet is simply not a substitutable through a EV bike. But in the car space, we are trying to understand how quickly you will say Tesla come to India, and can a Tesla launch a $5,000 car in India 4 or 5 years out. It is clear that there are talks afoot between our authorities and Tesla. It's also clear that, leaving Tesla aside, large EV electric battery manufacturers are also looking to move to India. So there's a lot of happening on the 3, 4, 5 year out piece, which we are trying to research and understand better.
Guys, my line is...
Okay, I just want to quickly revisit what the market rates are settling in at, because there's a sharp downtick. You thought it's going to be a more tempered start in line with the rest of the globe. Not quite, because that initial, flat move has only taken a tide for the worse. About 110 points lower right now for the Nifty futures. We're at 14,438 on the Nifty futures as we speak. The breath as well, it's getting really painful there, because we are 144 stocks lower within the F&O universe and just 15 stocks standing to the advances. That too barring Jubilant FoodWorks, which is holding up 2%, purely a news trigger based move there, and a couple of brokerage upgrades on the basis of their acquisition with Popeye, or rather their franchisee agreement with US's Popeye. WinGC is less than 1% higher. Apollo Hospitals, ICICI Pru, SAIL, etc. just marginally in the green as we speak. Trent, PNB, Z, RBL Bank, Indiabulls Housing, they've all taken a sharp knock. Tata Motors, Adani Ports, IndusInd Bank, Axis, Eicher, Maruti, SBI, they're all weighing quite heavy on the indices as we speak. Saurabh, how is it that you're approaching metals now? Because, while it's given that metal prices will continue to be on the uptick, metal valuations back home are cheap, but it's this heightened sensitivity to any and every global move coming in from China, which really, sort of puts back to focus the high beta nature of the listed metals universe. Your take on metals, whether or not this continues to be a meaty investment or not?
Look, whilst we all understand and understand the nature of the metals rally globally, which started, say, March last year, and we understand that if you buy Hindalco or JSW Steel, you can profit from that global rally in metal prices. I've never quite understood why people buy the stock rather than the commodity itself, because as you're rightly implying, Aisha, there's a high correlation, something like 70-80% correlation between the stock prices of metal stocks and the underlying commodity. And if you're buying a company which is a proxy for a commodity, then effectively you're buying the volatility of the commodity cycle. Since we in Marcellus have no expertise in predicting commodity cycles, we've stayed away from investing in the metal sector whilst admiring the rally in commodity prices and the stocks. So if we assume that the recovery continues, the global recovery continues, which I think is a reasonable assumption to make, then clearly metals and metal prices will rise, and you could enjoy further rally in the steel prices of ore converters. But I don't see what competitive advantage they bring to the table, and as I've never quite understood where exactly is the risk-adjusted return for our clientele.
While, you're continuing to adopt that approach of sticking to the leaders within most of the sectors, Saurabh, would that strategy hold true when it comes to even infrastructure and real estate, or is there going to be a fairly different approach to that space, given that we are now seeing things picking up? There is a substantial recovery in order bookings, in the sort of execution, some of the constraints on supply chain, etc. What's the approach here?
We're also seeing, I think, there are clear signs based on recovery in heavy truck demand. recovery in genset demand, recovery in demand for heavy cranes. This clearly the engineering, capital goods, infrastructure cycle has started moving up, as you said. But again, the challenge is, where can one find companies with comparative advantages, right? I've lived here for 12 years. I've never seen a real estate developer, infrastructure company, engineering cap goods company, which consistently is able to show me return on capital above cost of capital. So therefore, all we are buying is the cycle. And I've always been very wary of that. Why should we just buy the cycle? You're just buying into an economic upswing cycle, which could turn south without warning. And furthermore, if all you're buying is the upswing, then over time, as the economic upswing proceeds further, new entrants will come in and take away business and profitability from even the market leaders in engineering capital goods. So we've sort of tended to give these sectors, engineering capital goods, a wide berth. Metals and mining, real estate, given these sectors a wide berth, given the dearth of companies with free cash flows and return on capital above cost of capital. Our preferred way to play the cyclical upswing is high quality financial services, auto ancillaries, and increasingly the specialty chemicals plays in our country, which are becoming plays in the global chemical cycle rather than just a local economic recovery.
With the mobile phone now, Saurabh, having become practically our 11th finger, I mean, we're doing everything on it, spending copious amounts of time on it. There is that rise in the mobile phone penetration, decline in data costs, lots of new internet users as well joining in. So where does the potential lie within this, the digital economy or the telecom space, or however you'd like to play this story?
Right. So I think there's a lot of confusion in our country between high growth in a sector and profitability therein. So in the history of Indian mobile telephony, there hasn't been a single company which has delivered free cash flows to their shareholders. So you're absolutely right. I mean, we had from nothing 20 years ago, we've created one of the largest mobile telephony sectors in the world. And yet in the history of this sector, we haven't had one company which has delivered a rupee of free cash flow to shareholders. And hence, I hope you'll understand why Marcellus stays as far away from this sector as possible.
I'm just going to quickly check in on what the market is settling in at, and we're down 100 points right now. 14,455 is where we're currently at. On the downside, you've got 125 F&O stocks, which are weighing heavy, 33 odd standing to the advances as we speak right now. Saurabh, I don't know how much of a fan you are of IPOs, but a slew of primary market issuances hitting the street right now. I mean, valuations, of course, are debatable in the size of the issue, another parameter to really weigh in on whether or not you should be subscribing. But anything as a business model which has struck you, Nazara, for instance, the first in the online gaming business to actually debut on the street.
I think it is good to see new companies coming to the market. They bring freshness to the market. They allow the Indian market to broaden its exposure to venture capital and private equity backed firms. And from what we are hearing, there's plenty more IPOs in the pipeline. We're looking at these, but so far, none of them have jumped out as being, say, of a quality of, say, what InfoEdge is, what Naukri.com and the broader InfoEdge cluster of companies where they've taken the Naukri.com free cash flows and invested it in Zomato and Policy Bazaar. We haven't seen a powerhouse of that scale come through. The other thing that we are very wary of is if we look at how Google and Facebook have crushed competition in America, i.e. how Google and Facebook have crushed small digital plays which are vertical specific, a lot of these Indian e-commerce plays also seem to us to be equally vulnerable. They are niche plays, and therefore they operate almost at the mercy of the global monopolists. We're hoping to see a few more industry category leaders like Naukri emerge, who are very significantly moated. But as yet, whilst it's exciting to see the new companies come through, we haven't yet found a a robust, highly monopolistic play where we can deploy our monies and sleep easy at night, knowing that Google and Facebook or Amazon can't come and crush the smaller Indian players.
And what about the kind of movement that we've seen in crude oil prices? How do you see that impacting sectors like energy, oil marketing companies? Is this a sector that you'd refrain from, and what's the outlook?
Same point of view as metals and mining, right? Anything which is a play on underlying commodity cycles, why should one as an equity investor get sucked into that? If you're a commodity investor, you're a specialist in commodity prices, be it crude, be it metal prices, by all means invest in oil futures and in metals. But I've never quite understood why equity investors get so carried away by commodity-oriented plays, because the rational analysis shows that A, these companies struggle to generate return on capital above cost of capital, and B, if you look at the share price itself, there is no risk-adjusted upside. After you take the volatility away, there's very little left on the table for people like us, and hence both on crude and on the crude and the metals plays, we tend to give them a wide berth.
Okay, fair enough. That's the strategy when it comes to even looking at the entire oil marketing as well as energy space. But Saurabh, let's also get in your take as to how you're looking at various other asset classes in terms of diversifying the portfolio, because that seems to be one of the key strategies in order to, make sure that investors manage to capitalize on returns across the board. What's your take on the overall diversification?
So whilst we ourselves don't have expertise in terms of making equity investments abroad, what we have seen is that it's increasingly obvious that wealthy Indians, especially those who can afford to use their LRS quotas and invest abroad, should be looking to build portfolios of not just Indian monopolists, but global monopolists, right? And given that there are well-known global monopolists who are building globe-girdling empires, including empires in India, out of, say, headquarters in Europe or America, this sort of portfolio makes sense. So the maths we have done suggests an ideal Indian portfolio would be 2/3 Indian monopolists and 1/3 global monopolists, right? And the reason for 2/3, 1/3 is typically market-leading companies in our countries, in Asian Paints, a Pidilite, a Titan, take home 40% return on capital employed, whereas, say, the FANG stocks have 20% return on capital employed. So the Indian dominant players have double the return on capital of the Americans, and have for 2/3 to Indian monopolists, 1/3 to American monopolists would be a sensible way to build a really classy, powerful portfolio. So it's something we've been thinking through for a while, but we don't offer a service of helping investors invest abroad. There are other high quality fund managers who run large funds out of London, New York, San Francisco, and I think increasingly Indian family offices, Indian H&Ws are going to start doing this, where they say, I want a portfolio of the best Indian companies to take home, say, 80-90% of Indian economy's profits. And I also want globe-girdling giants who are literally eating up the world. And if you build such a portfolio, I think you'll get very muscular returns over the next 10-15 years.
Okay, great to have you on the show, Saurabh. Always good chatting with you.